The 2008 financial crisis was the most devastating economic collapse since the Great Depression. In just a few months, over $19 trillion in household wealth disappeared. Nearly 9 million Americans lost their jobs. 4 million families lost their homes. But what caused this collapse? Why did it happen so fast, and could it happen again? To understand it, we need to rewind to the early 2000s. After the dot-com bubble burst and the shock of 9/11, the U.S. economy was struggling. The Federal Reserve, led by Alan Greenspan, slashed interest rates to historic lows to stimulate growth. That made borrowing cheap, too cheap. At the same time, there was a big push for home ownership. Buying a house was more than just shelter. It was the American dream. Banks and lenders jumped at the opportunity, approving more mortgages than ever before. But here's where the trouble started. Banks weren't just lending to people with good credit anymore. They began handing out what became known as subprime mortgages. These were high-risk loans to people with poor credit histories, no steady income, or no financial proof at all. These became infamous as ninja loans. No income, no job, no assets. Still, the system kept growing. Why? Because the banks weren't holding on to those risky loans. They were bundling them into complex financial products called mortgage-backed securities, MBS, and selling them to investors around the world. These bundles were sliced and packaged again into something even more confusing: collateralized debt obligations, or CDOs. Wall Street couldn't get enough, and neither could global investors. Why were people buying this toxic mess? Because the credit rating agencies, companies like Moody's and Standard & Poor's, were giving these products AAA ratings, the highest safety grade. They were calling garbage gold. But here's the catch. Those rating agencies were being paid by the banks creating the products. That's like hiring a food critic, paying them extra, and asking them to call your raw chicken a 5-star meal. The system was rigged from the start. Meanwhile, housing prices kept rising. People believed the myth, housing always goes up. So they bought second homes, investment properties, and flipped houses for profit. It became a frenzy, a bubble. By 2005, home prices were peaking, and the loans being issued were getting worse by the day. Interest-only loans, adjustable rate mortgages, no down payments. If you had a pulse, you could get a house. But by 2006, cracks were forming. That year, the U.S. yield curve inverted, a classic warning sign of an approaching recession. Housing prices stopped rising. And when prices stopped climbing, people who had taken out risky loans couldn't refinance. They began defaulting. At first, it was just a few missed payments. Then the defaults spread like wildfire. Lenders started collapsing. In 2007, over 25 subprime lenders went bankrupt. Bear Stearns, a major Wall Street firm, saw 2 of its hedge funds implode under the weight of bad mortgage bets. But the worst was yet to come. In September 2008, Lehman Brothers, one of the biggest investment banks in the world, declared bankruptcy. The U.S. government refused to bail it out. That single event triggered global panic. The credit markets froze. Banks stopped lending, even to each other. Then AIG, the largest insurance company in the U.S., nearly collapsed. It had insured many of those toxic investments and didn't have the money to pay the claims. The government stepped in with an $85 billion bailout. Soon after, the stock market crashed. The Dow Jones plunged nearly 40%. Retirement accounts evaporated. Pension funds bled. Confidence was gone. The financial system was on the edge of total collapse. The U.S. government had no choice but to act. Congress passed a $700 billion bailout known as TARP, the Troubled Asset Relief Program. It pumped money into banks and financial institutions to stabilize the system. The Federal Reserve also slashed interest rates to near zero and launched something called quantitative easing, injecting trillions into the economy by buying up financial assets. But here's the painful truth. The banks got bailed out. Main Street did not. Millions of Americans lost their homes, jobs, and savings. Entire neighborhoods were gutted by foreclosures. Soup kitchens couldn't keep up. Unemployment soared to 10%. And while Wall Street was rescued, no major executives went to jail. The public was furious. Occupy Wall Street began in 2011 with the chant, "We are the 99%. The movement wasn't just about bailouts. It was about inequality, injustice, and the feeling that the system was rigged for the powerful. So what did we learn? First, deregulation is dangerous. Over the years, financial safeguards put in place after the Great Depression were removed. A shadow banking system emerged with no oversight and massive risk-taking. Second, conflicts of interest matter. Credit rating agencies were incentivized to rate risky assets as safe. No one checked the math. No one cared until it was too late. Third, the models failed. Wall Street relied on complex algorithms and mathematical risk models. But these models assumed that housing prices would always rise. They never accounted for widespread failure. And fourth, complexity is not the same as safety. The more complex the financial product, the harder it was to understand and regulate. When things went bad, no one could untangle the mess. The Dodd-Frank Act, passed in 2010, was designed to prevent another collapse. It created stress tests for banks and the Consumer Financial Protection Bureau. Globally, the Basel III regulations forced banks to hold more capital and reduce risk. But critics say Wall Street still plays by its own rules. The housing market eventually recovered. So did the stock market. But it took years. The psychological scars of 2008 still shape how people view money, debt, and the American dream today. And perhaps the most haunting lesson is this: the next crash won't look like the last one. It will come disguised as something new, something exciting, profitable, unstoppable, until it isn't. History doesn't always repeat, but it often rhymes. So the question isn't whether another crisis will happen. The question is, will we see it coming in time? See you next time. Like and subscribe.